everyone, welcome back with me. Don't forget to like, share, comment, and subscribe. This is partly because we envisage a level shift in consumption volatility that warrants a higher medium-term equity risk premium that is currently reflected by the market. While not exactly a crescent call to buy bonds, where it still sees yield and term premium below steady-state estimates, Robeco managers to view them as substantial keeper and upgraded a 4 years analysis return forecast for Aero had get developed economy sovereign bond by 1.5 percentage point. If the made expanded equity return by a quarter point. Major claims of paradigm shift requires a heavy burden of proof. We find insufficient evidence to conclude that we are close to a tipping point where elasticity leaves inflation in development economies spiraling out of control. Robeco concluded while acknowledging several competing scenarios. Others are more direct in causing bonds to protect massive investment. Societe Generale global asset allocation is man upgrade bonds by some 5 percentage point to 33% within its multi-asset portfolios, increasing U.S. bonds to 1/4 of the overall allocation, hedging the additional weightening in errors as they don't want to increase an already high 53% dollar exposure any further. The Federal Reserve credibility will continue to anchor inflation expectations under 2%. The SG term works in that we consider U.S. Treasuries to be one of the rare assets that have already priced in many of the risks ahead. Confiscate almost 4% nominal yields on U.S. Treasury credit over 2 years or more than 35% now for 10 years may just be enough to bank to rebuild the message 6 or 40 equity or bonds portfolios, taking such a bettering in 2022, as Pithead Wealth Management Chief Investment Officer Cesar Perez-Ruiz said earlier this month. 2023 could be the reference of the 60 or 40 letter pool U.S. Treasury yield outlook Rebecca card on asset allocation history. The opinions expressed here are those of the author, a columnist for Reuters. European stock markets are expected to open lower Wednesday as investors bracket for another hefty interest rate hike by the U.S. Federal Reserve, likely curbing growth in the world's largest economy. As O2OOET, the DAX future contract in Germany traded 4% lower. CAC 40 future advanced spread 3% and the FTSE 100 future contract in the UK fell 2%. The market focus is squarely on the U.S. Central Bank's Wednesday as it concludes its latest policy setting meeting later in the session. The Fed is widely expected to hike interest rates by at least 75 basis points following last week's other than expected U.S. inflation reading, but some are also pricing in the possibility of a 100 bps hike. The session is due at 14:80, and the Fed will also update its quarterly economic projection with sold profit guidance over where the policymaker think interest rates are heading, how long it will take inflation to fall, and the likely impact on economic growth along the way. The Fed handliness the week, the Bank of England, the Swiss National Bank, the Bank of Japan, and the Norges Bank in Norway are also okay. Maybe that's all from me. Thanks for watching. Don't forget to like, share, comment, and subscribe.